Hey everybody, this is Jose Blasco. I believe you should be able to hear me. Please confirm with a quick message on the chat box that this is the case. I would really appreciate that. We are about to start the session here. I just need you guys to confirm you hear me well. I believe it should be fine. I think so. Very good. Thank you so much, Miguel. Thank you for your patience as I had to reboot certain things and get restarted with others. So I appreciate your patience there and working with me on fixing the issue. Thanks a lot. I'm almost ready to begin the session. Yeah, I see everybody is coming back in. Very nice. So again, since this is a brand new stream, I have to reread the disclaimer for you guys. And from there we start. So disclaimers, the following videos, clips, demonstrations are for educational and instructional purposes only. Traditive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. Here we go. The session is introduced. Let's go for it. TradeStation is now working the way it should. I had to do a lot of rebooting and resetting on my end. Not sure exactly what the origin of the issue was, but what matters is that we are ready to trade. We are ready to run the session and everything seems to be working. So back to where we were. Okay, the beginning part of the session was supposed to be to review what we have at the moment. So one of the trades that we executed is Microsoft. We talked about it earlier, where we entered Microsoft expecting all times high, before that price level was broken. So around these price points, this is when we entered, and we can see that this market is working very nicely for us. The other trade that we executed was with CVX. This one went all the way against us. Okay, so we're having PD pending data. Lots of data is being re-downloaded, so we'll have to wait just a sec. It's going to show up in a minute. While CVX is loading, I'll start from the bottom part. Nike. So Nike is a non-directional trade. Okay, and expiration date is July 2nd. Okay, so we are almost there. So we entered this trade on that particular candle. Okay, that particular candle, that was when we entered the trade. We were expecting Nike to remain in a range. Okay, and as we can see, since that particular date, that's exactly what has happened. So the Iron Condor that was made of selling the 104 and buying the 105 call, selling the 92, buying the 91 put. So this Iron Condor, it's basically about to expire, and it's gonna expire for a full profit, isn't it? So this was another successful trade. So coming back to CVX, okay, so that stock, as we can see, didn't do much. So we entered a long time ago. It was more or less around May. CVX, it's higher than when we entered. Okay, this was a trade where we were planning on checks. Okay, so not all is lost. Okay, if CVX was to crash hard, this trade will actually start producing profits for us. Right now, CVX is a trade that is being used as a hedge against the other trades that we have in the account, which are long. Okay, talking about long trades, going back to the bottom part of the list, we have Gilead Science. This is a trade where we got long the other day. Okay, the other day we went long. Not much has happened. Okay, not much has happened. As you can see, this market is just basically going sideways. Really, nothing at all is happening. And as of now, this trade is showing a little bit of negative P&L. If I was to bring back Option Station Pro, you would see that very easily. So let me do it. Okay, almost there. Just checking the chat box if all of you are back, and it seems that things are back to normal. So let's focus on the bottom part of the screen where we have here GILD. Okay, you can see it shows a little bit of negative 110 PNL. And by the way, if you recall that session, okay, you know what I said. And this trade is a trade that was planned in the You Can Trade channel. It was not done in the YouTube channel. But when we did this trade, for the ones of you that joined me there, I said that using a call, like a naked call, like buying the 80 call, was not the right way to do it. And I was going to do the trade so you get to see what happens. Okay. And in this case, we get to see the pain of time decay. Okay. Together with, if I was to add another column and I was to add Vega. So the right trade to be done on GILD was a spread, but unfortunately there was no liquidity when we did this trade, and we didn't do a spread. So I said, let's do it so you get to see what happens. Okay, so for an educational purpose, okay, this trade is in the account not because the trade is the way it should be. Okay, it should not be a call, it should be a spread, but there was no liquidity. So therefore, really the right action was to not to take the trade. But okay, so why is it that we are more or less at the same price level where we started, and this options trade is showing negative PNL? Why is that? Well, because since not much has happened since we started the trade, we started the trade with around 30 delta. Now it's 27. So that tells you that the price of the stock went slightly a little bit against us. Okay, so it went a little bit against us, just a little bit, tiny bit. Okay, instead of 30 is 27. So maybe you would expect that these may provide, 20, 30, $40 of loss. So how come we got 110? Okay, well, putting on the side the spread, because I executed this trade with a market order, we have been suffering $4 of time decay every day. With a spread, it would be less. And on top of that, Vega is positive 6, which is a pretty large number. Okay, it's a pretty large number. And I mean, think about it. The trade that we have with Microsoft, which is a stock which is $200 per share, okay, which is like almost 3 times the price of Gilead Science. Microsoft got 10.85 Vega, where the trade with Gilead Science has 6.27 Vega. Okay, so if you think about proportions, it's much more. Okay, and it has to do with the fact that the option on Microsoft is deep in the money, where the one with Gilead Science is almost or closer to what the money is, the 80 call, and the price is 76. So that's why we got more Vega there. But again, you can see the impact. Okay, so if volatility didn't move the right way, and time is passing, and the stock on top of that hurt a little bit, next thing you know, the P&L, it's actually quite painful given what is happening. Okay, so again, the lesson to be learned here is that Gilead Science should have been executed as a spread, and because it was only a long call, we can see all that additional pain coming in. Okay, this is the complexity of options trading, that really complexity could be seen as a negative word. To me, it's a beautiful word in this sense, because it allows you to do more things. But for ones trading options that are not fully knowledgeable on how to use options, they may read a book and they decide, if I want to make money when the markets go up, I buy a call. If I want to make money when the markets go down, I buy a put. And they keep it that simple. And in certain market conditions, okay, keeping it that simple makes sense. But in other cases, with other types of market conditions, doing a spread is the way to do it, or even other combinations to mitigate the impact of either time decay or also the volatility exposure. Okay, and again, this trade was put in the account with a market order to display the whole pain that this trade is suffering, which is number one, spread because of using a market order. Number two, volatility against the trade at a rate of 6.36 against the trade. On top of that, time passing against the trade with a very short expiration date, which is 24th of July. So it's very few days, 22 days, DT, 22 days, days to expiration, 22 days only. So high rate of decay. And on top of that, the fact that the stock went against the trade by a little bit. Okay. So it's a good lesson to be learned. And that's why today I wanted to start the session by doing a little bit of review. Okay. What else? More trades that we have running. We have Abbott. Okay, we have Abbott. So I let Abbott load. We also have Cigna. Okay, I will also allow Cigna to load pending data, and then we have Union Pacific Corporation, which is also loading. Okay, so let's go back to Abbott. Hopefully, Abbott is already fully loaded. It is. Okay, and notice that Abbott is a trade that we put together here in the YouTube channel, if I'm not mistaken. That was on 6/12. Okay, that was on 6/12, and on 6/26. Okay, which was last week. We reached our expiration date within the purple range. Okay, so that was another profitable trade that we had executed that I never had the chance to review with you, if I'm not mistaken. So that's why I'm bringing it today for you. Okay, then we got Cigna Corporation, which this one is a trade that we put together the other day. Expiration date for this one is 17th of July. So for that one, we still got 2 weeks to go until we get to expiration. Price is in the middle of the range. The statistical range suggested on the day of the trade that price would stay between 215 and 174. We have UFOs above and below to protect that even further. So we used the 165 and the 220 options above and below. And as of today, price is in the middle of the range and is looking good for the trade to work well, even though we still got 15 days to go. So there is some uncertainty still, but it's looking good for now. Okay. UNP, Union Pacific, same story. This is another trade where expiration is going to be reached today. And also we are reaching expiration date while price is within the range. Okay. So hopefully you guys appreciate those reviews. Most of those trades ended up profitable, which is nice. It's not always like that, okay? Especially if you are too loaded on non-directional trades and the markets pick up speed, many of your non-directional trades will fail because remember, stocks are fragile. So if the S&P was to crash or was to rally very strong, most of the stocks would follow, and what could be seen as a likely range for the stock to trade within may be broken because something very strong or very weak is happening on the equity markets, in the S&P, for example, in the main indices, okay? So that's why, again, coming back to a concept that we discussed before, when you're building your portfolio, you should have some diversity. Some of your trades should be pointing to the long side with positive gamma. Some of your trades should be pointing to the downside with positive gamma too. So positive delta, positive gamma, negative delta, positive gamma. Okay, and then you should have some non-directional trades to kind of offset a little bit of everything. The non-directional trades gives you theta, which the directional trades suffer theta, and the non-directional suffer gamma, the directional enjoy gamma. So you have a lot of offsets in different places, and this should help you to produce more consistent results in your portfolio. Okay, so before I begin planning new trades for today, again, today I spent a decent amount of time reviewing trades, which is something that maybe we should do a bit more often. I guess it's useful, but I would like to get your feedback about this. Is it useful, guys? If you see me review trades like this, is it helping you to understand better the what happened during the life of the trade management, the different possibilities of things that happen? Please give me a little bit of feedback on that on the chat box, okay? Because in my mind, it should be useful, but again, you have the final word there, okay? Cool. While I'm waiting for you to answer, so let's begin the day, okay? And since we see, since the weekend is approaching, isn't it? So I'm looking at potential non-directional opportunities based on the scan I run before the market open. And if you notice, GLD is an ETF, and all the other trades we got here, apart from NEM, Newmont Mining, most of those stocks are not too liquid. So what I'm going to do is I'm going to give the scanner a chance to hopefully find new opportunities. So I'm going to rerun the scan, and in the meantime, I'm going to be looking at opportunities to either go long or go short, and hopefully we can at least have one trade ready before the session ends. Okay. Leland, trade management is valuable, very good. Yes, it is good, Ruben. Thank you for that. Yes, Fairmont, reviewing the trades is great. Wonderful. Perfect. Love it. Again, what we do is obviously with good intention, but it's always nice to get your feedback, because maybe we're doing something that in my mind is useful, and then next thing you know, is not what you need. So it's always appreciated that you guys are sharing your feedback. Okay, so let's take a look at Adobe. Okay, so what do we have with Adobe? So Adobe is a company that is giving us a climate which, based on stats, being a blue climate, it should be 8 candles going up. This is candle number 2. So certainly we have a go ahead to trade Adobe. And finally, I am having the same problem I had before. Don't tell me this is what's going to happen today. Yeah, even here, it's taking a long time to load the... Well, I'm not very happy about this, guys. I'm sorry. But I guess there must be a network issue beyond my location. Maybe my internet provider is having an issue, and that's really the origin of what's happening. Okay, it seems that something is loading now, so hopefully we'll have a chart. Come on, this is when the fun part starts. I mean, the reviewing the trades, you guys confirm that you appreciate it, which I'm glad. But planning the trades and executing the trades, that's the fun part. So that's where I want to be. Okay, so I need Adobe to continue loading here, and I need to get to see the stats for the UFO performance. And once I get the stats, I need to confirm if the trade is valid or not, which I believe it could be. It could be a valid trade, but again, I need to confirm. So come on, Adobe. Wow, it is taking a very long time. So let me click on Broadcom. Let me click on FedEx as well. I will also click CVS. So all those charts begin their download. And I'm back to Adobe. So there is a problem, guys. Okay, there is a problem. I'm going to cancel the scan. Maybe this is not helping as well. So hey, let's use a little bit of patience here, and we'll stay positive, guys. We'll do our best. Again, cannot wait to put threads together for us to execute. But if it's gonna be like that, and let's face it, this could happen to you any trading day. Now I just got disconnected from the order execution network. So yeah, it's looking like there is a network problem somewhere. I don't think it's my location because I reboot all the devices, and it's probably my internet provider or some sort of an international connection between my country and the US. Okay, now it seems that it's loading. Okay, so let's go with it. Okay, so we have Adobe. Okay, we have Adobe, and Adobe is providing us using regular market data. Regular hours market data is providing us 48%, which is not acceptable when doing non-directional trades. So I'm going to move to pre-post market, and we got 40%. Okay, so believe it or not, institutional interest as of now for Adobe, it's not enough for us to bet on a directional trade. Okay, so very simple, we go for the next one. Okay, it's a shame because we had a UFO that was lining up perfectly. So basically, I was looking at it like, that's it, we got a trade. It's gonna be an easy one, but no, the probabilities basically negated the trade. So we don't break the rules, isn't it? Good. So what do we have here? Okay, 49.23% with AVGO. That is not good. What about pre and post market? Pre and post market is 43%, so we are not going to take that. So what about FedEx? So FedEx is loading, so we need to wait a little bit. In the meantime, I'll take a look at the climate. Okay, so the climate here, it's candle number 2 in this blue climate. Okay, and blue climate suggests that the market should move up by 6 days at a time, okay, at least 6 days. So in other words, 2 out of 6, it's certainly a good time for us to enter. Now with pre and post market data, we got 45%, which is not acceptable. So if I move to regular session data, that becomes 47, which is not acceptable. So we're going to go for the next one. That was CVS. Notice I'm skipping GILD because we already have it, and also T-Mobile. I'm just keeping it because normally it's a little bit of a slow moving stock. So I'm just looking for something a bit more spicy. Okay, nothing wrong with T-Mobile, absolutely not. Okay, especially if you want to hold the stock and get paid dividends and things like that. So it could be a good one, but it's not what I'm doing. Okay, so 47%. So if we move to pre and post market, what do we have with CVS? We got 53%. Okay, so this is now what we want. We got 50% or more. Notice that the institutional interest is greater here with the pre and post market data instead of regular session data, which to some people is very, very shocking, but that's the reality of this market. Okay, so AutoUFOs is kind of revealing the actions of those institutional players, which happen to trade CVS more heavily or with more reliability in the pre and the post market trading hours instead of the regular session hours. Okay, so we got 3 candles. Okay, in this up climate, the up climate is supposed to be 6 candles. Remember, I always round up 6. So 3 out of 6. Certainly, we are on time, and being on time, we need to keep in mind our reference point, which is 64.69. That's our reference point. That's the EMA. Okay, that's the EMA. So 64.59. And notice how we do have UFOs right there at this price, 64.56. So perfect. We do have, and remember with stocks, there are a few cents difference. It's okay. Okay, this is not trading futures intraday. This is stocks. Stocks are fragile. I knew you knew I was going to say that, isn't it? And therefore it's okay to be a bit flexible. So the moment price, if CVS was to drop a little bit and hit any of those green UFOs, we would be basically hitting or very close to the reference price. And from there, we would expect the climate to continue progressing to the upside. Okay. And by the way, there is no, at least in the 55-minute time frame, there is no UFO anywhere close. Okay. So it's looking good, but again, let's follow the process religiously. So the process is first look at the climate. The climate, I said it before, is allowing us to do a trade on CVS. Number 2, with the same time frame, check the target. The target for CVS. Okay, let me write it down. The target for CVS, it's going to be 68.98. That's the target for CVS. Okay, that's the rival red UFO. Okay, the rival UFO is the target. The entry is going to be 64.56. Okay, so entry is going to be 64.56. Okay, and that's the plan. Okay, and that's the plan. So let's go ahead and load CVS in the option chain. CVS, not to be confused with CVX, which is a different stock. That one we are short. Okay, it's an oil company, it's Chevron. We are about to get into a trade with CVS, which is CVS Health Corporation. It's obviously, I'm sure you are very familiar with the CVS pharmacies and so on around the whole country in the US. So it's totally different company. It's not CVX, it's CVS. Don't get confused, okay? So now we got the option chain. First thing we need to select is what expiration date to use for this directional trade. So that would depend on the time to target calculation, isn't it? So we said the target was going to be 68.98. Okay, that's the target. We said the entry was going to be 64.56. Okay, so we're talking about $4.42 of a distance to be traveled to reach the target. And if we were to look at the daily ATR, okay, for CVS, it's 163. So in other words, if I take this figure of 442 divided by 1.63, this is telling me that we need 2.7 ATRs to get to the destination, and we give ourselves 7 days per daily ATR. This is the rules we use. So that basically is 19 days. Okay, so we need 19 days, 1 9, to get to the final destination. So when looking at the option chain, I need to use at least July 24. At least I need to use this one. Okay, but notice I said at least, because the other part, the other portion of the rule is, I'm bringing trading view. We look at CVS, okay, and we're gonna look at the next earning report, which happens to be on August 5. So we need to utilize that date, or the nearest date to that particular date. Let me rephrase that: the nearest expiration date to that particular earning date, to mitigate as much as possible the effect of time decay, as well as enjoy as much as possible the effect of volatility rising. So therefore, since August 5, it's after July 24. So for sure, it's going to be August 7, as you can see. It's going to be 36 days, which is more than 19. That was our minimum. Okay, so we're going to be using August 7 expiration date for this particular trade. Okay, I'm not too happy really with the spreads I get to see here. Okay, 209.76. I'm not really happy at all about the spreads that we see here. Yeah, I'm just gonna I'm gonna go to a further date. Okay, so let me explain. Okay, and this is where common sense comes into place. Okay, so the rules tell me I need to use August 7. Okay, but if I use August 7 and let's say I buy the 65.5, I'm gonna suffer a spread. Okay, which is the difference between 276 and 209. So I'm gonna suffer $67 on the spread. So just by going in and going out, you're gonna lose $67. So now, what if I was to, or let me look at the 65. Okay, so if I look at the 65, because it's not a decimal place, normally liquidity is better. So 263 minus 221, right? So spread is less, it's $42. So I'm losing $42 if I do the 65. Okay, now the 65 in August 7 is worth 263. If I move to the monthly expiration date, August 21st, which is more liquid, it costs me $286, and I only lose $8. The difference between 277 and 284, it's $7 now, $7 to $8. So now again, earlier we said you would lose 42, and the cost of the trade was 265. So the two together is 307. So I rather pay more for the trade, okay, and not suffer so much spread, because even though you would think the option is going to be more expensive because you use a longer expiration date, the reality is that, as you can see, because the liquidity is much worse in the August 7 expiration date, it's actually a worse deal compared to using August 21st. Okay, so I'm gonna go with August 21st. We talked about this many times in prior sessions. Monthly expiration dates are often more liquid compared to weekly expiration dates. With some stocks, it doesn't matter because they are super liquid. You pick Facebook, for example, it doesn't matter. The S&P ETF, SPY, doesn't matter. But with certain stocks, you do see the difference as you saw today. So we need to adapt and use common sense in this adaptation. So hopefully my rationale here made sense to you. Okay. Now, let me make a note, which is absolutely critical for this trade. Okay. So, okay, I'll come back here later. So even though we are using August 2020, and it was what? August what? It was August 21st. So we are using August 21st here. Even though we're using August 21st expiration, we need to be out prior to the earnings report, okay, to the earnings day, okay, which is supposed to be, okay, August 5. But you need to watch that because this may change, okay, this may change, okay, so you need to watch for that. But again, as I explained, common sense suggests that using August 21st is better, even though now you know that even though we're using August 21st, okay, before August 5, we need to be out. Okay, so August 4, the latest, you are out of this trade. Even if you didn't reach the target, get out. Okay, unless you're in the losing territory. If you're in the losing territory, it doesn't matter anymore. But if you're in the profit territory, collect your profit and you're done. Okay. Okay, so let's put the trade together. We're going long, so I'm gonna do two things. I'm just gonna analyze them by a single option and a vertical. Okay, I'm gonna analyze both to see which one produces the best outcome for the trade, and this is the one I will execute. Okay, also I only need 2 price points, which is my target located at 68.98 and my entry located at 64.56. Okay, so I am unchecking the single call, and let's begin with the spread. So for the spread, we call that a bull call spread. You're gonna have to sell a call. Okay, sell a call. The call we sell needs to be beyond target. Okay, the target we said it's 68.98, so I would like to start with selling the 69 call, which probably will not work, but I'm gonna start there, okay, because it makes sense. And then I need to buy a call, and the call I need to buy, I'm gonna start with the 65 call, okay, because the call I buy is supposed to be between entry and target. Okay, that's where it needs to be. So my entry is 64 something. So 65 is between entry and target. The one I sell is 69 because my target is 68.98, and obviously 69, it's beyond the target by 2 cents. Okay, so we're doing 65, 69. Let me adjust this. 65, 69, there is no 69, so we're gonna do 70. Okay, 69, 70. And the first thing I wanna check is the delta values, which as you can see are 27. That's not good enough. I want it to be 30. This is one of my rules. The next strike is 72.5, so let's do this. And now it's 36. Okay, so how can I make this closer to 30? Well, I could rise the 65 to be 67.5, and it doesn't work. It drops too much. Okay, it drops too much. So we are dealing with an option chain with which is providing strike price increments of $2.50. So as you can see, I am lacking precision, and I cannot be more precise because the options given to us on the chain are $2.5 at a time. So I cannot be more precise than that. So I'm going to have to make a call. What is better for me? To do the 36 delta or to do the 27 delta? Okay? And the answer to this question is the 36 delta is going to be better. And why is that? Because of gamma. Gamma here is positive, and here is negative minus 123. Negative gamma is problematic. Okay, negative gamma is problematic. So if I move this to 72.5, my gamma is still negative, but less negative. Okay, so I got less pain with gamma, and I got a bit too much delta. Okay, but that's one way to do the trade, which is not perfect, amazing, but it's okay. Okay, so that will be one way to do the trade. For sure, I could get less negative gamma if I move this to, let's say, 75, but then I'm going to get way more delta too, right? So now my delta is 42, and now everything is positive gamma, but now my delta is 42. Okay, so again, to keep the rules the way we use them, so 72.5, that would be the plan for this trade. Okay, so 65, 72.5, this is option number one. So I'm going to uncheck the vertical spread, and now I'm gonna do the single option and see what's better. So 67.5 is providing us with 34.91 delta. Okay, 34.91 delta, and positive gamma everywhere. And this trade would cost 145. Okay, I cannot do 70. Okay, I cannot do 70 because if I do 70, not only my delta is too little, okay, then 70 is beyond the target. Oh, I just type here beyond, it's beyond. Okay, 70 is beyond the target. And the rule is the option you buy needs to be between entry and target, not beyond. 70 is beyond, so I cannot do 70. Okay, I cannot do it because of two reasons: because it's beyond instead of between, and because delta is 22 instead of 30. So and 65 is going to give me too much. 65 is giving me almost 50 delta. Okay, so 67.5 is my only choice. It would give me 34.8 delta, and all gammas are positive. So I'm happy with that. Okay, I'm happy with that. The cost of the trade is 144. 144 at the entry point is the estimation from the simulator. 144. So what if I go back to the vertical spread? What's going to be better? So the vertical spread is going to cost me 200. Okay, a bit more delta, but then I also have negative gamma. Okay, so what's best? Well, in this case, and also, given the fact that liquidity is not that amazing, so I'm going to go ahead that we keep it simple, we minimize the amount of units, and it's going to be a better trade. Okay, so we're going to go with buy the 67.5 call. In the end, we're not going to do a spread. We're just going to buy a call. Okay, so we are buying the 67.5 call. We are not doing a spread, so I'm just going to delete everything else. Okay, using August 21 expiration, we're buying the 67.5 call, but of course, we have an activation rule, right? Our activation rule is 64.56. Okay, so I'm going to go ahead and place the order, and this is how we will conclude the session today. Okay, I'll look at your questions and comments as well before the end of the day, but basically that's the trade of the day. So I'm going to go ahead with a market order and an activation rule and a day order. Okay, so market, activation, day order. And I'm using market because I'm using a SIM account on TradeStation, and because it's a SIM account, I won't get filled unless I use market order. In your real trading, make sure you use limit orders as we have discussed before in the sessions. Okay, so keep that in mind that we are doing that differently. Okay, so CVS, so less than or equal to 64.56. Okay, that is the activation rule. Okay, activate your order based on 64.56. Okay, that's the rule. I'm just gonna click OK. Okay, and now I'm gonna place order, and I'll have a final confirmation window here. So, do you want to buy the 21 of August option 67.5 call at market price? Day order if CVS drops to 64.56 or below? Yes or no? Yes. So 1, 2, 3. Okay, and now if I look at my manage tab, okay, here I got a received order to trade CVS. With again with all the parameters we just discussed. Okay, so the order is in. Of course, I won't get filled unless CVS, okay, drops a little bit and comes here. And if it comes here, then I will get filled, and then the climate and the UFOs are supposed to push it back up, hopefully to reach our target at 68.98, which is basically up here. So that's the trade, my friends. I'm just going to make a note and keep it here so we can review it in the future. You guys tell me, any question? How was the session today? Any question, any comment before we conclude the day? Before we conclude the day, any question, any comment? Let me see. Can I show the scanner settings for that? Furman, if you don't mind, I would like to ask you to send an email to our support team, support at tradewithufos.com, and we will send you a PDF document with all the details of the scan. I think it will be better. Yes, I see that, Lilan. Thanks for that. Miguel, Jose, considering the white space between the red and the green UFOs for the 15-minute chart, shouldn't be easier to trade the CFD instead? You are dealing with a totally different animal. If you're trading with the CFD, you are giving up the markup that the broker adds, and you will not enjoy positive gamma, which options tradings have. So you are basically just totally changing asset, and therefore the characteristics of the trade is totally different. Also, if you use the CFD and the market goes against you, the more it drops, the more you lose. Where with this trade, it's going to cost you $145 per contract, and no matter how deep CVS drops without the use of a stop, you know the most you can lose is 145 per contract. There is no way you lose more than 145 per contract, even if the stock goes bankrupt. With a CFD, if the stock goes bankrupt, you lose the whole thing, right? And being stocks a fragile asset, we have 1, 2, 3, 4, 5 UFOs right there on top of each other. The most likely going to produce an impact is going to be the 6456. That's why is our entry. But it would not be a surprise to me to see price go to the next UFO or the next and turn then, because stocks are a fragile asset and they react and depend on other variables such as the equity indices and so on. So using a CFD puts you at a disadvantage, and it's a totally different animal. I would recommend the use of options is much more efficient. Okay. Boyan, how are you, Boyan? Ruben, thank you very much. Yeah, yeah. The gap is huge, but with options, you're gonna get positive gamma to enjoy the gap, right? And before we conclude the session, very quick, this is the beauty of gamma. Let me show you. The beauty of gamma is that you start a trade with 34 delta, and when you get to the target, you got 60 delta. So it's like you purchase 35 shares, but when you take profits, it's like you got 61 shares. Magic. Who did that? Gamma. You have no gamma with the CFDs. Okay. If one of your CFD contracts represent X amount of shares, when you get to the target, you collect a profit on that amount of shares. There is no gamma in CFDs. Okay. So hopefully that makes sense, everybody. This will do for today's session, guys. Again, I would like to apologize for a couple of technical issues we had along the way. Still not really sure of what it is. It's looking like it's probably the internet provider, so sorry for that. But in the end, we were able to review the prior trades and add a new trade, and hopefully the session was useful to you guys from all angles. So thank you very much, everybody. See you next one. You guys take care. Bye-bye, and see you soon. Bye.